All right, welcome back, guys, to Crypto Insider. Good to have you all here. It's going to be a huge update. A lot of news coming out this week, and it's a very, well, how to say, volatile week ahead. A lot of things can happen. Before I start with that, just for your attention, you can sign up to my free newsletter. It also has a paid subscription to it, so you can see more in-depth analysis, and I share my portfolio along the way, the decisions that I make. If that's something interesting for you, then you can do that. You can sign up, especially because I think the next bull run will all about fundamentals. So if you pick the right coins or you're stuck with meme coins, I don't think you will do well, but that's completely up to you. I don't give any financial advice. I just give my view on the market. It's my opinion. And same counts for this whole video. I just give my view, and you can do with that information what you want, right? All right, so let's have a look what's going to happen this week. So, we have a list of news coming up this week, as you can see. So for Monday, it's relatively easy. I do have to mention that on Monday, China is going to have a bank holiday. We got some GDP numbers coming from Great Britain, which will not be great. Also, the Italian industrial production will not be great. This has everything to do with the energy crisis. You can check on my Twitter. What is this about exactly? Then we move on to Tuesday, and then we have a very interesting metric here, which is the CPI, core CPI, month over month in the USA. Now, obviously, we've seen like big inflation over the last, let's say, 1.5 years. This has everything to do with the relief packages after the corona lockdowns. Obviously, a lot of new dollars into circulation. We all know about that. Right now, we also know that the Fed is doing quantitative tightening, QT, and we know that this is pretty effective. The Fed is well ahead of most other markets. Well, the Fed is well ahead of Europe, that's for sure. The USA doesn't have the issues in the electricity market that Europe does have. So we can expect a good number. Market forecast minus 0.1. Last time I also said we would have a good number, and we also had a little market rally because of that. So what we can expect, I think, based on what I've seen, the numbers that I've seen, and based also on the oil price coming down, a lot of commodities really came down a lot. I think we can even think of minus 0.2 to minus 0.5. I would say somewhere minus 0.3 or even minus 0.4, I think, is a realistic target for the CPI. Now, normally the market would rally on a positive number and the dollar would drop. Well, I think that can happen. I think that's very likely to happen, but we do have to take into account that the Fed has a very hawkish stance, and they said literally that they would not depend their interest rate hike decision based on the current CPI number, because it's obviously still way too high. So this means that, normally a market would expect a more dovish stance from the Fed. I don't think matters too much in this specific situation. Also, there's a lot of treasury bonds, treasury bills expiring or maturing this week, which could expect something around 75 billion wiped off the balance sheet already for just this week. So I think that's very interesting, because you will have somewhat dovish CPI versus actual QT kicking in this week. So it's very mixed signal. Potentially we see a rally through Monday, Tuesday, and potentially Wednesday, Thursday, we could see a reversal back down. But let's just scroll through these things here. PPI will come out. We'll have CPI in Britain coming out. These will all be bad numbers. Europe is really a mess right now. We already spoke about that, so I'm not gonna go back into that again. Retail sales, this could still be all right. But retail sales, I also spoke about this already before. We do expect less and less consumer spending because the delayed effect of inflation. Credit cards are maxed out in the US. You basically have, let's say, Fed adds a lot of extra dollars into the system. You have a delayed effect of inflation. And then you have, when you get inflation, you have a delayed effect on consumer spending because the first, let's say, year or half a year, consumers will compensate their spending with their savings. And there was record savings after, or people build up a quite good saving during the lockdown. There was also QE, so in that sense, we will see a delayed effect of consumer spending, which I believe is about to kick in right around this moment. Like we had summer, people had, let's say, literally or relatively speaking, they spent still quite a lot. For the fall/winter, I do expect those numbers to come down, and I also expect earnings to come down. So let's see what we also have. Consumer sentiment, USD. So that would be the US consumer sentiment. I also expect this not to be a great number. It's slightly recovering. We have to see. I think it's kind of flat. Like it would be relatively flat, maybe comes up a bit. I don't think that's super relevant, especially because it comes at the end of the week and the whole move is already done. This video, I want to really explain a bit further about market making versus retail, let's say the normal trader, and how this market dynamic works. So let's go to the big news this week, which is the Ethereum merge. Now, I think first off that the Ethereum merge is super great step for Ethereum to move to proof of stake. This is the future. Governments are pushing for less environmental impact, with mining, etc., etc. So the move to proof of stake makes a lot of sense. You have people for it, against it, whatever. I think it's a good move. Yet the merge itself isn't really highly impactful. The burn mechanism that they introduced last summer was much more had much more effect on the price than the current merge. So yes, it's a big step. It's the biggest update on the Ethereum blockchain that we've seen in its history, which makes it not necessarily a bullish thing. It makes it actually a risky thing, because there is, like, no one really speaks about this, but there is risk that the merge fails, or there's risk that some things break in DeFi. Like, the whole crypto industry runs on Ethereum. So if something goes wrong there, you see there will be billions, hundreds of billions of dollars, stuck in protocols, stable coins, DeFi. So it's a very, I'll open a beer to to watch that in 4 days, 14 hours and 38 minutes and 12 seconds. So but let's have a look, apart from the technical, point. And I think this is what people forget about. Like, they look at the chart, and they are like, okay, Ethereum's going up, so it must be bullish. Let's just have a look at some data and let's understand how market makers work. So let's look at the exchange reserve. Like, exchange reserve comes down, which is in essence a bullish metric. Yet again, you have to understand that market makers, they work with a balance, right? So everybody that understands the balance sheet, then they know that there's assets and liabilities, right? So assets are the stuff that you own, and the liabilities are your potential costs, or are your costs that is capital that you owe to others, right? So for a market maker, you have to understand that the assets that they own are either, well, that first and foremost, assets that they own are coins, right? As a market maker, you can only sell something if you already own that property. So coming back to, let's say, before the start of the bull run, here we had like Ethereum bottoming out here around $100 before the big run up, right? This was in the lockdown crash, right? When the lockdowns were announced. And you see the exchange reserves going up, which means effectively that market makers were scooping up. They were scooping up as many Ethereum as they could, right? And then you see also that, like, buying was relatively speaking flat. I mean, yeah, there was some degens buying Ethereum here, but there wasn't really that much confidence, right? Probably until this move here, right? But you see that they start distributing at a price of 4 times that, like around $400 here, right? And they have been distributing, scooping up, but mostly distributing all the way up from $400 to $4,000, 4,600, 700, whatever. And that's what a bull market does, right? So bear markets are points for market makers to accumulate. You can clearly see that this line is going up, and going into the bull market, this line is going down. So obviously there's also a technical point of view that the Ethereum in circulation is much less. People are staking it into ETH 2.0, and there's this burning mechanism introduced based on transaction fees. So obviously there is less ETH to buy, and there's less ETH in circulation. So obviously it makes sense that this exchange reserve comes down. Yet again, you can see on a shorter time base what market makers are doing here based on price action. So they've been distributing, buying some dips. If they run low on coins, they buy dip, they push price up, and they start distributing again. The capitulation point here of a lot of, you guys know, June, a lot of people capitulating. There they were actively buying. You can see that this was the clear uptrend here on the reserves, right? And you go from 24 million to 25 million. So yeah, they have been actively buying here, and as soon as the price goes up again, like really up, this is the steep uptrend, they've been selling again and distributing. So from that point of view, if you wouldn't really look at this massive steep increase, you would say we're not that bullish yet. And that is also something that represents in the other liabilities that market makers have. So market makers, this would be a spot balance sheet, right? Spot holdings, you sell and you buy. So market makers, they would buy the dip and they would sell the rip, right? That's basically what they do. And in an order book, what they specifically do is just move up their sell walls. So retail is basically chasing the supply, right? So when it comes to buy walls, when they really step into buy, that's really where a buy wall kicks in, where high volume buy walls are placed here around that $900, which happens to be also a huge liquidation point on Aave, where a lot of Ethereum positions were liquidated. So from that point of view, they've been scooping, when you get liquidated, that Ethereum goes to the market maker effectively for free, right? So that's a good business, right? So what's the market maker? He provides liquidity, but he only provides liquidity in a way that he makes money, right? That doesn't mean you cannot make money. It means that you need to manage your risk, because when his risk becomes too much, right? When his liabilities become too much, then he will bring price to a place where his balance sheet is in balance, right? Where he is in the plus. So that we can really easily see that on the options, right? So we have spot that we just explained, right? Spot is just holding, buying and selling ETH without any leverage. Then you have futures, where you borrow more Ethereum or borrow more dollars to buy more ETH and have more profits. And those profits need to be paid by market makers, right? And if you are running a profitable position and you close in a profit, the market maker loses money. But if he can offset that with money that he makes from his spot balance or from open interest on options, then that's still a fine trade for a market maker, right? So we've seen that with I can show you that on the Ethereum Bitcoin chart a little later on. But like how this balance sheet works is really nicely well to see in open interest. So the blue bars are puts, let's say shorts, just to be simple, and people get paid on the basis where, if I had a put here at 3,000 and price is below 3,000, that's a position in profit, right? Well, very clearly to see that this is a huge volume here from, you know, people that were very bullish on Ethereum and said like, well, price is gonna, you know, be above 3,000, which obviously isn't. So these, everything below these green bars where we are right now, we are currently around 1700. So everything on the right from this current bar is profit for the market maker, which you can see is much more volume than the puts, right? So basis on of liabilities on the balance sheet of an options dealer, this is a good trade. This is a good balance sheet. I love it. Like they're making a lot of money here, right? So we have some expirations this week. We have one on 11th September. This is what we call the max pain price. So you can, you know, based on every expiration, you can say, well, what's the ideal price for the market maker to get as much money out of his positions and pay as the least amount of people, right? Normal people. So that's the max pain price, right? So which is always at the middle point, you know, taking out these calls and not paying off this huge volume in puts, right? In shorts. So, but we have to look, like we can just look at this and say, well, okay, the ETH price on 11th of September is going to be around 1650. Well, that's reasonable. ETH price on the 12th of September is going to be around 1750. Well, that's reasonable. Then we go post merge, which you can see it's already lower. So we can say, well, the ETH price post merge is going to be on the 16th of September is going to be 1600. That is reasonable, yet we have to also understand that 11th of September, 12th of September, 16th of September, 23rd of September are all expirations with very low volume. The real expiration comes on the 30th of September, which means, again, on the balance sheet of a market maker slash options dealer, that he doesn't really care too much about 11, 12, 16, 23. He needs to make his money on the 30th of September. And look at 1.6 billion worth of calls. So let's look at that 30th of September. And then you can see we're running a good business here. Literally, if he would drop, let's say we would have a sell the news event on Ethereum, and the price would drop below $1,000, right? Then we would be here. Let's say we would drop to 900 in the case of a sell the news event, or potentially the ETH merge, there were some problems, whatever. Then yes, you would pay off these puts here up till here, which is $64 million worth of puts. But you would literally wipe out all the calls here. So sorry, this is not that just that one bar is 64 million. So I have to just go here and look. You would have 1.6 billion worth of calls expiring worthless, and let's say you would have pay out maybe 300 or 400 million worth of calls of puts. So calls, puts. And so now you understand like how this business works, right? So it's always trying to hunt for the liquidity. That's liquidity hunting, right? So if you understand this, then you are so much further ahead than the people that are just like drawing some fucking lines on the charts and doing some technical analysis. Like, it's not like I don't do any technical analysis, but my main point of reference is to know, okay, where's the market maker standing? We're gonna go into that on Bitcoin a bit deeper, but now we understand where we are with Ethereum, right? So let's just dive over to the Fed story for one more time and see that the Fed is now really starting to shrink their balance sheet. So we went from, let's say, 9 trillion here to 8.8 trillion, and we are working our way down. Really, we're like accelerating the pace, which is not great for a risk-on environment. It's much better for people to either invest in less risky assets. Definitely not stocks, definitely not crypto, right? So we got like a Vanguard graph here, and that just says what's the optimal balance sheet. These guys know much better than me, so it's a very interesting graph. Coming towards, let's say, 5 billion, 6 billion, trillion, sorry. Well, that's a lot of work to do for the Fed. I don't think they will manage to bring down their balance sheet that severely. But they will try to work their way down, and they look at inflation, they look at unemployment, and they look at production output of the country, right? So we talked about consumer spending. As you can see, the goods in inflation adjusted dollars are coming down. Consumer spending is still coming up, but if you count in inflation, it's already coming down, and we will see this line curve over and see less spending. We already see that in Sweden. You can clearly see that, when the inflation really kicked in at the start of this year, the spending came down. Like, it's very simple. Like, if you have less money, if your energy bill is 2 times as high, you have just less money to spend on other things, right? It's a very simple principle, which comes back to earnings, right? So usually the S&P trends together with the earnings, which makes a lot of sense, right? So you buy a stock, the company is worth X amount based on the amount of money they make, and this let's say this metric completely blew off, especially if you look here after the COVID relief packages came. So there was so much money, extra money coming into circulation. People don't know what to do with it, especially fund managers. Well, they do know what to do with it. They will invest in the market, right? And so that inflation is first seen, if you would call it inflation, I think you can, in stocks, right? Stocks are the first one to move. The money arrives in the money markets, and from the money markets it will move to risk assets, stocks, commodities, all of these things, right? But especially in a risk-on environment, you will invest in the economy, in companies which are stocks, because they have more money to spend. They will have higher, people will have more money to spend, so they will have higher returns. Makes a lot of sense to put in stocks. So you can see the deviation here on this chart, how far the S&P is away from their normal, let's say, fair value, stocks on fair value. So there is still a lot of work to do. This chart is not very updated. I think it's from the start of 2022. So this line is already quite a bit lower, but you can see that like a normal market bottom is at least below this line, right? Any bottom in the stock market was since, let's say, the 90s was below that line, right? So we still have quite some work to do here in the stock market. Many people see Bitcoin going up on a Friday with 10%, and they say, okay, this is the end. It's the end of the bear market. I very much doubt it. So It also has something to do with the amount of credit in the system. We have consumer credit is at its all-time highs right now, measured since 2000. And this is obviously people compensating their extra expenses when it comes to inflation. First they eat into their savings, and then they start maxing out their credit cards. And so we do have a bit of a debt bubble here, and we have an energy crisis in Europe, and huge debt in Europe. Potentially, companies need to be bailed out in Europe, the energy companies. There's a lot of risk still in the system. The leverage, so to speak, is not flushed out of the system yet. To claim there is a bull market bottom right now is very risky, in my opinion. Yet again, I'm not saying it's a huge, it's a very bad point to buy. Like in crypto, we've been coming down, at least on Bitcoin, something around like 70%, 65%. It's not a very, very bad decision to buy some Bitcoin or Ethereum right now. But I would rather approach it from a dollar cost averaging point of view at the current moment than to YOLO in all your savings. Well, what people did do is YOLO in all their savings into buying stuff with hugely elevated prices. There was also huge demand. So as you can see, the savings went from peak levels, basically all-time high levels, to back to nominal mean levels here that were sort of the normal levels since 2012, more or less. So let's dive into some charts here. Bitcoin moves along with the stock market. So here you have Bitcoin. You see clearly the correlation to the S&P. Bitcoin always moves first. You can see that here from the 2007 peak, Bitcoin moved first, and then the S&P went up, and then Bitcoin followed. Same as you can see here. This was kind of synced because it was like a sort of a special event, right, with the lockdowns. And they moved up in sync again. It's clear to see this distribution range in Bitcoin roughly between the 35 and the 60K here. And now we are potentially forming a very beautiful double bottom here. From a technical standpoint, if I wouldn't have any macro data on the market, and I would solely have trend lines and technical analysis, I would say, well, I would long this bottom. I would definitely long this bottom, but I would keep room to absorb Bitcoin coming down back to this level, which is around the 12K. So it would be, if I would use leverage, it would be very low leverage long / swing trade to trade this market back up again. So I think what is very interesting to look at is this chart here. And I need to get this. So this is the federal funds rate. And let's see where we at here. Okay, so basically federal funds rate like completely got smashed after the financial crisis. And basically where this is all QE, this is all very flat, low interest rates, and the market could rally. So this is not a very, this also when Bitcoin came out after the financial crisis. So you see a market condition that is very unique, let's say, right? You have very, very, very low interest rates, and you have quantitative easing. So obviously the risk on environment profits from that, and you see a huge rally, right? So, and so what makes this what makes this current situation a bit different is that we're now, this was a reaction to the market coming down, right? And so if this comes down together, that's the normal approach, right? Because you're gonna start helping the economy, you're gonna stimulate the economy when the economy comes down. Now it's a bit of a different situation because we basically create ourselves a bubble here, and now we are actually hiking to get that bubble back down, which is actually a bubble created especially by QE after the lockdown. So right now, if we look at what's been going on here, we could see that once the federal funds rate peaks out, the market bottoms. That's like perfectly aligned, right? So what I would like here is the federal funds rate to this is a relative federal funds rate, right? So it's a federal funds rate relatively to the S&P, right? So this is the S&P value relative to the federal funds rate. So what I want to see is this level being hit again. Like we have very much more hawkish Fed than back in 2018. So it makes a lot of sense for the federal funds rate to at least come to that relative level. It says zero everywhere, but it's just a relative level because it's like a bit of a messed up metric. If you start doing weird stuff like this is these are my secrets. So and it doesn't really matter, it's just a relative value. And if we look at where we are in the cycle, if we get a really big ass bear market that we haven't seen since the dot-com bubble or the financial crisis, then we can go much lower. And funnily enough, we are actually following those fractals really well. We're actually front running both fractals measured from the top back in January. And well, if we look here, the stock market bounced perfectly here on the 1.618 extension to the downside, and that obviously makes a lot of sense for for the stock market to bounce. We also have a oversold RSI on the 4 hour. We have a slight bullish divergence as well, especially in terms of price. So what we're looking at right now in relative sense is to say, okay, if we want to do a bit of technical analysis here, we can just drop an alarm here on this trend line and see breaks trends and see when this line is broken what we have right there. You also have this relative trend line of resistance here, so that gives us quite a nice view of, like, it gives us some breathing space inside this this triangle here, pennant, whatever you want to call it. I do expect the stock market to stay inside of this range and potentially on the in the coming weeks, where you could say, okay, CPI is coming out, it's quite bullish, so we could potentially rally back to this extension level here, range a bit, but I do expect them to at least hit this liquidity here, and potentially going to this extension here, the 2.618, right? which would be around, let's say, 3,500 over the course of time. From there, we need to really be paying attention, because we're coming to levels, relative levels that are actually quite close to even the dot-com bubble already, even though dot-com bubble came much lower, still like 25 extra percent. If the situation is that bad as in the financial crisis or in the dot-com bubble, it's a bit hard to say, because you have a very accommodative Fed. But honestly speaking, from a geopolitical point of view and a financial point of view, I think it's much worse. Honestly, it's much worse. But it depends on monetary policy. Like we've seen that in the previous chart, that monetary policy determines where the market goes, right? So we definitely need to keep an eye on the FOMC meeting, the Fed meeting later this month, to see what is actually going on. Well, we already know what is going to happen. We will have a very hawkish Fed, and the Fed didn't like this rally, and they know that if they are in any way are too dovish, the market will just rally straight back to all-time high. So they really are very cautious in being too easy on the market, let's say. They've been easy now for over a decade. Now it's time for them to really unwind the balance sheet and get that market down to a point where they can be accommodative again, and where things are a bit more normalized in that sense, right? So what's actually interesting here is that, if you look at this level here, you could say, this retrace is very similar as this one, right? You have you have an M formation here, you have a retrace into the neckline, sort of an M formation here, retrace into the neckline, coming down, seeing, these sort of spikes when it comes to, which are literally just like short squeezes, and then coming back down. So this could also be a short squeeze. So we shouldn't be too happy about that. Also, that we have a gap there that will get filled at some point. So relatively speaking, we could see what the S&P is going to do at that level. So let's have alarm there as well, actually, so you guys can also place the same alarm. And we just do SPX resistance, so we can see what is gonna go on there. So potentially we come back to this extension here, because we do have a little bit of a gap, but it's a very small one. Now, if we look at fund rates here, you can clearly see that this situation is much different now, because you see them coming down in bear markets, relatively small bear market here, but coming down as well, especially on the lockdown move here. And now that it's coming down and the federal funds rate is coming up, right? And we are about to break out like an historical trend here, at least the trend since 2000. So that makes things very interesting. Now, coming back to Bitcoin, coming back to the market maker story. This is the liquidation chart of Bitcoin on Friday, when price was at 20K600, and you see that there is like hardly any liquidity here. There was hardly any shorts to squeeze, there were hardly any longs to take out. So this is where there was thin liquidity on the books. Like I've tweeted literally about this, that I would expect Bitcoin to be back above 20K. I got a bit tricked because of that sideways movement, so I closed prematurely It can happen sometimes, but I should have just stick to my original analysis. I expected the move down to grab liquidity below below those levels. So let me just open the Bitcoin chart so we can have a look together. Oh, this is on Coinbase. Wait a sec. Let me just open Bitstamp without any of this nonsense. All right, so and we just open a thicker volume here so you can have a look at what the market maker has been doing here. So oh, we already had it. Okay, so big push up, a lot of transactions here, which is not necessarily that great, honestly, because you can see when you have these moves, they come back into the liquidity. So they didn't had any liquidity here, and they just literally built it themselves. There was thin liquidity in the book. They pushed the price back up. They took here they took all the shorts out that were built from this level here, from 21.5, and now they are looking to potentially coming back up to this level. I think this candle here is very interesting at around the 23k. So we can also drop a little alarm here, and we could call it BTC resistance. This is how you do it, peeps. You need to just help yourself with some alarms. We do see a slight bullish divergence. Like normally you would say this is a double bottom, right? Yet again, given the market conditions and what I'm just going to show you with liquidation levels, this could also be a distribution phase to head lower. We know there's a lot of liquidity still to the downside, so that's something we need to look out for. If we want to see that, we can do that. Let's see if we can just use this. Let's see. Up. So let's go here and check it out. Yeah, so there is a lot of liquidity that they still left here to the downside, which I anticipate them to come back to. This is XBT on BitMEX, but we get already the idea there. So let's have a look at the open interest right now. So this was the open interest before the move. So and then everybody YOLOs in, and look at here. Look at how many long liquidations they have built here, just below, let's say, just around 20k, right? So they have, just Binance has, let's say 75 million long liquidations there, and these are all like different lines, right? Different price levels. So in total, you can think of like at least $1 billion worth of long liquidations, just around 20k. So this is something that we need to be very cautious of, and see where price is going to go to in the coming days. Now, as you can see, you can also we just ran into the mean. We ran back to the 50-day EMA. We need to see whether this is a real break, something like this here, or if it's just something like this here where you tap the EMA cloud and then get rejected back down, or here, same story, or this kind of behavior here. And if we look where there's still liquidity to hunt for them, it is these vectors are hunted here. Let me just go into the log chart here, and we talked about this area here as well, where we have this huge vector candle. which is around 12K. So that's definitely a level that we need to keep an eye on going forward this week. So if we take this liquidation chart, we can only conclude that there's not that many shorts for them left to squeeze. We have Ethereum options that are showing that like lower prices are favorable for market makers, as well as the long liquidations. So I think we need to be very cautious going forward together with all the news. So the way I would play this week is what I believe is likely to happen is whether we run up going forward. Potentially we keep bullish until the FOMC. Maybe they will counter trade the bullish CPI numbers, like build the short squeeze there and then smack it back down. Also on the S&P, there is the most of the shorts are squeezed there. Like there's not huge open interest left. So I do expect dealers to start hedging again against a more bearish trend. So that's it for this week, guys. I hope you enjoyed this update. I think we went over a lot of things. I think we need to be a bit more patient to confirm a market bottom. I'm not currently trading. I will be there on Sunday night on Twitter to discuss the weekly open and potentially place a trade. But we will have to see how the week opens in order for us to see what price could potentially do. A bearish, like if we go down on Monday, I would be more bullish than if we would pump on Monday. So that's it for now, guys. I hope you enjoyed this one. Join me on 10x Club. Join me on Twitter. Blow Off Topic is my username here. So we can wait. Let me see, hero. And then we see each other on Sunday Eve, and we'll go over the price action from there. Alrighty, peace.